What are dividends? How do they work? What do you need to know about investing in them? And what are some good examples of good and bad dividends? We're going to go over all this in the video. And if you are new to the channel, hit that like button for me and don't forget to subscribe for more videos. So what are dividends? The first basic answer to this is dividends are a portion of a company's profits that they are paying to you as an investor for investing in their company. Now, the amount that you would receive is based off the dividend yield of a company. So if a company's dividend yield is 2%, that is an annual yield, the amount of money, the percentage return that you would make off of your investment from that company in that year. Now, these payments are actually not paid every year, they're paid every quarter, which is every 3 months in the year. An example of this is that if you had a company that's $100 a share and you had a 2% dividend yield on that company, you would get $2 back. And if you had a $1,000 investment, you would get $20 back. But each company pays the quarter, so you would actually get $5 every 3 months and not $20 at one time. Let's say you have a strong company and the dividend yield stays consistent, so let's say it stays the same. So the first year you make a 2% dividend yield, you go from a $1,000 investment to a $1,020 investment. Now that was just based off the dividend income you made after 1 year. Let's say the company's share price also went up $10, so it went to $110 a share. So your investment was $1,000. You add 2% of that from dividends, so that's $20. You got a 10% increase in the stock, so that's another $100 of the 1,000. And then that equals $1,120 by the end of that year. If you continue to invest in that stock, you would have a 2% dividend yield, not on 1,000, but on 1,120, which would give you $22.4, which would give you about $5.6 every 3 months instead of $5. Now, increasing $2 a year is really slow and not what you want, but if you continuously add in money, it will compound more and could eventually go from 2 to 50 to hundreds to even thousands if you have a lot in 5-10 years down the road, and that would make you a high return, and you can actually have that as income, or you can have that reinvest to make even more and more and more. I want to hear your guys' thoughts. Leave a comment below if you think dividend investing is the right approach to investing in stocks. I have heard a lot of people that say that if they don't pay dividends, it's because they reuse that money to reinvest, which would make the company grow even more and more because they're reinvesting it into their own stock. So it's really a combination of which one you think is better for which company. So let me hear what you guys think about that. Fun fact, do you ever think Warren Buffett would have thought he would make $4.7 billion from dividends every year? No, I don't think so. Now, if you're curious how Buffett gets all this money from dividends, these are the stocks he invests in and the amount that he gets for each one. Now, all his data is from the year of 2020, not from any other years combined or anything like that. In 2019, he actually had a total of $3.4 billion from dividends, where this year he had $4.7. And a lot of these companies are very big and safe companies. If you were to invest in them, it'd be safe options in the long term. Now, a big example like this is Coca-Cola. You're never going to see any brand of Coca-Cola like Coke, Sprite, anything that's in that not be used. People are going to still drink those. There's no competitors that would pay the same price for an off-brand versus a Coca-Cola brand. And that's exactly why Warren Buffett bought Coke. There's niches in the market like Coca-Cola or Pepsi are the only two that are really outbidding beverages. Everything else is not. So if you pick a good company in the market that's a niche, which means it's a company that's very different from others and has no competitors because they're so much better, pick one of those. Another quick example is Apple, where they have a few competitors, but they are the niche in that company. They outbeat so many other people. So many people refer to have an Apple iPhone, a computer, a MacBook, whatever it is, Apple is the niche. And because they're this company that has people attached to their phones and MacBooks that buy them every year or two, they are allowed to keep making profits, which can then lead to more workers and more advancement in their technology, which then leads into a bigger and better company. And that's exactly why Warren Buffett invests in Apple and has majority of his money in that, because if it increases by even 1%, he makes a few $1 billion. And yes, if he loses 1%, he loses on billions of dollars of Apple, but if he holds it for the long run, he will make a lot of billions of dollars. Now, I don't want you to think that you can live off dividends, because that $2 improvement and the $20 every year isn't going to do anything like that for you. But if you continuously add into it, you can see an improvement. So an example here is that I'm going to say $2 million and you have a 3% dividend yield annually. That means that you would get $60,000 per year just on dividends. You don't even have to reinvest it. That can be cash to you. You don't even need a job at that point. You can literally just make that amount of money and use it whenever you want, and that's normal income. So if you want to invest and make money on your investment and still have a return where you don't have to work and you just want to keep getting cash, invest in big companies that are strong companies that still pay out the dividend yield. All right, so now that we went over what they are and how they work, we're going to go over how to invest in them and what you need to know. The first thing is that non-qualified dividends are taxed at higher ordinary income tax rates, whereas qualified dividends are taxed at the much more favorable capital gains rate. Okay, so I bet you're asking, what are qualified and non-qualified dividends? Now, to have a qualified dividend stock, you need to own the stock for a long enough time, which is about 60 to 90 days before the dividend's paid off. And it also has to be paid by any sort of company in the US or corporation that ties to the US to make it a qualified dividend stock. Now, if you aren't qualified and you own the stock like 20 days before the ex-dividend date, which is the day that the companies track if you own the stock or not, then that amount of dividends that you would receive would go to your tax income bracket and would not be for capital gains that you would in normal stock investments. Now, the reason they do this is to control the rich people from abusing the market, where if they were to put $1 million in the ex-dividend date 2 days before it and sell it 2 days after, but they still got the dividend yield of 2% of $1 million. Now that would make them a lot of money instantly, but because the government doesn't like that they can abuse it like that, they're making them put that in their tax bracket, which makes them pay a lot of it back to the government. And that's why big investors invest in the long term, so they avoid the tax income bracket taxes and instead they go for the long-term capital gains. Now, because we were just talking about big investors, Kevin O'Leary is a huge dividend investor and he loves them a lot. And here's some things that he says that will probably make you want to invest dividends more often than not. So he says that over the last 40 years, 71% of the stock market's returns came from dividends and not capital appreciation. He also says that the statistics are like a form of gospel and that knowledge is the bedrock on why he built his rules for investing. So what that means is that 71% of the last 40 years of gains in the stock market come from dividend money, dividend investing, and not from capital gains where a stock goes from 100 to 120, you get $20. But instead it's actually the dividends. Now, this is more than likely because the biggest investors invest in big dividend stocks and the fact that they don't grow 100% every year with a return, but because they guarantee you a 3 to 5%, 2%, whatever the dividend yield is, they guarantee that back to you. And even better is that if it goes down, that means that you would still have a safer action, because if it went down 5% and you had a 2-3% dividend yield, it would go from -5 of your return to a -2% return. That's a huge difference if you're a big investor, and if you were to make an 8% return plus 3, 11% return. That is a big difference when you're trying to compound money and continuously add on and being a long-term investor. And now you're probably wondering, what are Kevin O'Leary's rules of investing? Let's go over that. So his 3 rules for investors are that you should not have more than 5% in any one company, and you shouldn't have more than 20% in any sector. You should also avoid volatility, because that is the enemy, is what O'Leary says, and that you want to stick with less volatile large caps and dividend payers. So he's saying don't put in half your money into just Apple or one certain company. Don't put 80% of your investments in just the energy sector. And the last key takeaway is that you really need to look into companies that are profitable when you invest in dividend stocks, because that is where dividends are pulled from. If you invest in a company with negative profits, they're more than likely taking it from their cash in the bank, and they might not even be growing, so that's a bad sign, and they could be losing a lot of money because of that. And you also want to see uptrends in the profits. You don't want to see downtrends. If a company is down, not a good sign, and if it's going up, it's a good sign for you to see a good return in dividend yield and be guaranteed to get that amount back. Yet alone, the company is probably growing at the same time, making the share price go up and also compounding your money even more. For any of you that are still confused or may ask, what happens when a stock splits? Let me show you an example of that using Apple's stock and the previous split in August. So as you see, Apple April 30th declared that their stock was going to be recorded on May 11th as 82 cents per share that you owned. So what that means is that on May 14th, you would get paid 82 cents for every share that you owned in Apple. Move on to the next quarter, July 30th, they declared the exact same thing, 82 cents, for it to be recorded on August 10th and paid by August 13th. Now, dividends are just regular cash. You can either put it reinvested into the company automatically, or you can have it given back to you as just cash, and then you can use that for other things, like maybe you want to have it as income, or you could use it as more money to invest in other stocks. Now, on July 30th, they also declared that they were going to have a 4-to-1 stock split on August 24th. So what this means is they're going to divide the dividend yield by 4 from that 4-to-1 stock split. So on October 29th, they declared that they were going to record a 20-cent dividend yield on November 9th and have that payable on November 12th to you back as an investor. So what that means is that if you owned Apple in July when it was $400 a share, you would get 82 cents of a return. But now, because it had the stock split of 4-to-1, now you would get about 20 cents of a return from the dividends, but you would also be only paying for a stock that's about $115 a share because it was split by 4. And now we're going to go over a few stocks that pay dividends and why they're good or bad stocks to invest in. Now, the first stock is Dominion Energy, which Warren Buffett actually bought this previous summer of 2020, and their dividend yield right now is about 3.3%. Just taking you look at the chart, you can see that it has a good uptrend over the years and that it's really not anything negative and it's continuously growing. Now, it's not as fast as a company like Tesla, but it still has a good long-term return. And it's also good to look at the market cap because it shows how big the company is and how safe it is to invest in. And since it's a $63 billion stock, it's about a pretty good sized company. And then even looking below, the PE ratio is about 37, which is really good. And that basically relates its earnings to its previous earnings. And that means that it's growing and that it's continuously beating and doing better and better. Usually when there's a PE ratio above 15, there's a lot of speculation with the company to keep doing better and better and continue their growth with futuristic effects. And just a couple of statistics from Yahoo Finance, the total revenue has increased over the past few years. You want to see that, you want to see it growing, as well as the gross profit. That is a really good sign, especially because the gross profit is taken from the dividends, and that's how a company pays dividends. Now, these aren't all the factors to determine whether you're going to buy this stock or not, but these are really good determinants of whether or not this dividend stock is safe and can give you a long-term return. And you also need to make sure they have history of consistent payouts for their dividends, which you see right here. It is continuously growing, which is a good thing. A lot of these companies actually have a decrease in dividends, and that's because of COVID and their share price going down, but that's just a factor of because of what's going on. And besides this fact, as long as the company's dividends are still growing and they consistently pay them out, that's a good thing to look into. Now let's take a look at some real estate companies, which NYMT is a pretty common one, and that has a dividend yield of about 8% right now. Now before it crashed because of COVID in March, the dividend yield was half of that because the company's value was about 6, 7. So that's actually why the dividend yield is a lot higher right now. So if you were to invest in a long-term dividend company, this might be a good one to invest in. But you do have to be careful with these companies because they could easily be affected by COVID again, and you have to see the size of the company. This one is 1.4 billion, which means it's a little bit smaller of a company, which means that it might be more risky for you to own that stock. Now let's take a look at the history of the company, and they consistently pay out every single quarter, which is a really good thing. As long as the company does pay these off consistently, that is in good standards because the company financially is able to support that and still grow the business as well. A company that missed quarters or even stopped for a few years might be a bad sign, especially because that means that the company was not able to make enough profits to pay back dividends to investors. MFA is another real estate company that's at $3.85 a share right now. You can see the market cap is about the same size and the dividend yield is 5.2%. Now this is definitely another pretty risky stock, but for the long term, if you were to invest and go for the dividends on this company, it might pay off in the long run. Now before going out and buying these stocks, these are ones that might be affected by COVID, especially if it keeps going. Who knows what could happen? But if you were to buy strong dividend stocks that have good profits, not like these ones, but more safer ones, that might be a better investment for you depending on what your scenario is and the risk reward for you. And then let's look at the dividend history of MFA, and you can see that the amount that they pay you is about consistent through all the years. They don't really skip any quarters, so that's a good sign. Now looking at Apple, you can see their dividend yield isn't as high. It's actually below 1%, and they have a good market cap because they're a huge company, and the PE ratio is about 37, which means that they are good and they're consistently growing and have a lot of future effects for investors to think that it's going to keep growing. The business model behind Apple is so strong that if you're a long-term investor, you should not worry, not even look at it, or don't even sell no matter what happens, because in the long run, it's just going to keep growing until there's signs that say it's not. And as you see, Apple's dividend history is consistent, which I would never assume that they would ever miss out on a dividend because they're such a big, strong, and growing company. And here's a company I'm about to show you that doesn't pay dividends and why they don't. And that's Tesla. In the past few months and years, they've consistently grown higher and higher and proven themselves to be a strong company overall. Now, a huge reason the stock has blown up is because look at the gross profit. It's gone from 2 to about 6. Years before this, it was negative, which is not a good sign for a company, but now that it's switched and has consistently grown, it is improving a lot. Now you may ask, why don't they just pay dividends now? They have a lot of money, they have good profits, why don't they do it? And that's because they say that they intend on retaining all future earnings to finance future growth and therefore do not anticipate paying any cash dividends in the foreseeable future. And that's because they say that they intend on retaining all future earnings to finance future growth and therefore do not anticipate paying any cash dividends in the foreseeable future. And that's eye-opening because that just shows that Elon Musk is trying to make the company better, more futuristic, and continuously grow and improve its business model for the investors. And that will actually give and because they're growing their company, that might make them a better stock because that might give them a higher return in the share price compared to just an Apple share price and dividend on top of that. Usually when you look into a dividend stock, you should look into really big companies that don't need profits to continuously improve their business. Like Apple, they have $90 billion of free cash they don't need. That's why they pay dividends. They don't have, like Apple, they have $90 billion of free cash, and paying dividends, just a portion of that isn't a big deal to them. But to some companies, like real estate companies that need the money, that need to do this, but they still try to attract people to the dividend percentage, you got to invest in companies that are big ones like Apple that have the safe money but also want to give that to you back as an investor, but continuously grow the business as well, which is what Apple is doing. Leave a comment below what you think is a better option, like Apple with their safe dividends, or Tesla, or maybe Amazon with their high returns and growth in the company. Let me know what you guys think. And that about wraps up the video. So if you guys have any questions or concerns, leave a comment below. Let me know what you guys think about this stuff. And don't forget to hit that like button and subscribe for more videos. Thank you guys.